Okay, we are going to look at inventory, and basically we need to know how much our inventory is costing us. Okay, how much it costs, the cost of the product, but it also includes cost of any transportation, any setup, and if we look at this little notes packet, you can see here in our formula, the cost of goods formula, okay, the actual cost of our merchandise is important because it eventually affects our gross profit and our net income. Okay, so we need to make sure that we know what we purchased, but we also know what the value of our ending inventory is and the value of what we've actually sold. So we're going to look at some ways we keep track of our inventory, and then ways that we put a value, a dollar value, to our inventory. Okay, and again, the costing of this merchandise is important. Okay, to be accurate, because again, this page 145, shows you how it overestimates or underestimates all of our financial statements, our profit, our net income, and so this is an important piece to know that we're getting this number correct. All right, so like I said, the cost of our merchandise is not only the actual cost we bought it for, but any transportation costs that we might have. So just to kind of go over that first, our cost of goods is equal to the actual good plus any transportation or setup, or and or setup. So if it's something large like equipment, then there might be actual setup costs involved with that. Now, there are negotiations, or it may already be laid out who is paying the transportation cost or the setup costs. And those are some terms that we want to be familiar with. One is called FOB shipping point, which FOB stands for freight on board, and there's FOB destination. And this graphic is on page 146 in your book as well. Okay, so we have the buyer, and we have the vendor. Okay, and if our agreement is FOB shipping point, that means that at this point right here, the buyer takes possession. Okay, this is now in the buyer's inventory. Okay, and the title of the goods passes now. Okay, that's FOB shipping point. So at the shipping point is when the buyer is taking possession, and our vendor is our supplier. We need clarification on that. Okay, and then we have FOB destination. And that's when we take possession, the buyer takes possession at this point. So it is now in the buyer's inventory. Okay, and this is when the title passes. Okay, so this is important for accounting purposes. Okay, to know who's paying the shipping and when those become part of our, well, this may not necessarily be who's paying the shipping, but more we take possession. And there could be reasons for that, like if, the truck drives off the bridge right here, okay, at this point, right after it leaves the vendor. Well, whose insurance company is going to cover that loss? Is it going to be the vendor or the buyer? Well, who owns it at that point? At this, if we FOB destination, the vendor still owns it, okay? If we have FOB shipping point and the truck falls off the bridge at this point, then it's the buyer's responsibility, okay? So hopefully they have coverage for that. Good insurance coverage. Okay, so a little bit of extra information there. Two ways that companies keep track of inventory. One is a physical inventory, where they actually go to the shelves and they count everything. That needs to be done for every company at least once a year. You need to physically go count your merchandise, and you'll see that happen at your stores. You'll see tags on the shelves that says, notes about this has been counted or that kind of thing. So whenever the fiscal period is getting close to an end and they need to do that physical count, if you pay attention in the stores, you can see that happening. Okay, with actually going and counting the items on the shelves, whether they have a handheld device that's doing that or paper that's doing that, whatever the case may be. Some companies may also have a perpetual inventory system, which is a continuous inventory system. So as they're purchasing product, it's automatically going in to their records, most likely in a computerized system. And then as product is being sold, it's going to track it as well. Those can be costly. Okay, so if you're a very small business, that may not be something that you want to invest in. And so there's some other ways that we're going to look at how we handle our inventory that way. But right now, what we're going to look at is that perpetual inventory system, and this is on paper. Like I said, most likely this would be computerized. Okay, but that perpetual system is a continuous. I know that didn't look right. Let's spell it right. Okay, and so basically our system tracks as we buy and sell product. Okay, then like I said, at least once a year we need to do a physical inventory, which is an actual count. This can be costly because you usually have to bring in extra employees to do this or pay them overtime. Okay, and this needs to be once per year minimum. Okay. All right, so what we're going to do here is we're going to track a product, and like I said, we're doing this on paper. Most likely it would be done in a computer system, but this helps you with the gist of how it would work. So for working together 5.1, we need to fill in the stock record at the top. It gives us a description, which is the wireless monitoring camera. And the stock number is C4264. It tells us that every time we reorder, we order 100 of them, and our minimum is 20. So we're going to watch our balance in our quantity column, and as soon as it goes below 20, we know that there's going to be an order placed for 100 more to come in. Okay, and then we also have a location. in our store, in our warehouse, whatever the case may be. Okay, then 662. And then it tells us that we have 68 units in stock on August 1st, and then we're going to watch the purchases and the sales as we go through a couple of months. So on August 1st, we start out with 68. And then, again, we're on page 150 for our working together. August 22nd, we are making a sale. Okay, so here's our increases, our decreases. On August 22nd, we make a sale. Sales invoice 675, and we sell 50. Okay, so at this point we need to do the math. 60 minus 50 equals 18. Okay, now this is the point that we've fallen below 20, so we know that a reorder is going to happen at this point. Okay, because it's less than 20. Now, we're not going to actually record it till we receive it, but just in your mind, know that this is what is actually happening. And then on August 31st, we make another sale. Invoice 712. And they want 12. Thank goodness they don't want more than 18. And that takes us down to 6. And then we had ordered back here, so then on September 5th, we received that order. Okay, that was purchase 316. And like I said, our reorder quantity is 100. And then we keep doing the math. So 106 is our new total. Okay, and then September 14th, we make another sale. Invoice 785 for 18. 106 minus 18 is 88. Okay, so that's our working together 5-1. You're going to use this same page to complete this record and complete on your own 5-1. Okay, just continuing with these numbers.